Hey everyone, welcome back to Corporate Decoder, where we decode the mysteries of corporate finance. And today we're diving into World Acceptance Corporation's latest filing, looking at a significant development in their funding strategy. This is a company that has been around for a while, focusing on consumer lending. And today we're looking at a big deal they inked to secure a substantial amount of money to fuel their operations. Think of it as a big financial lifeline to keep the business engine running smoothly. So what is happening here is World Acceptance Corporation, or WAC as we call them, along with their subsidiary WFC Receivables, ILLC, have entered into a major agreement. This is essentially a big pot of money, $175 million to be exact, that they can draw from as they need it. This type of financing is called a warehouse facility. This is a short-term loan often used by companies that deal with receivables or loans themselves. They use this facility to get funds against those future payments they expect to receive. Now let S get into some of the nitty-gritty of this deal, because it tells us a lot about how they're remanaging risk. The total advance rate is typically 75%. This means for every dollar of consumer loan receivables they put up as collateral, they can borrow up to 75 cents. However, and this is important if something called a level I trigger event happens, which sounds a bit ominous, that advance rate can drop to 70%. This means they can borrow less money against their assets if certain conditions are not met. It is like a floating interest rate, but for the amount you can borrow. The interest rate itself is a bit complex. It is tied to something called benchmark and a benchmark replacement adjustment. Basically, it floats depending on market rates, and if a major shift happens in how those rates are calculated, they have a plan B to figure out a new rate. It is designed to be flexible, but also to protect the lenders. Then there is the margin, which is set at 3% per annum. This is a standard markup on top of the base borrowing rate. What is interesting is the step-up margin. This means the interest rate can go up significantly if certain events occur, for example, on or after a specific date called the revolving period termination date, which we will talk about more. The margin increases by 1%. And if an event of default happens, which is a serious breach of the agreement, the margin jumps by a whopping 2.5%. This is a strong signal that the company is expected to perform, and if not, the cost of borrowing goes up considerably. They also have to pay a fee on any of the money they don't use. This is called the unused commitment fee rate, and it is set at 0.50% per annum. This is common in these types of facilities. Companies pay a small fee to have access to the funds, even if they aren't actively borrowing them. It is like paying for a reservation. Now, let's talk about timelines. The facility has a revolving period, which is the time when they can draw and repay funds. This period starts on the closing date, the 29th of September 2025, and ends on the 29th of September 2027, or earlier if something called a facility amortization event occurs. This 2-year window is crucial for their short to medium term planning. After the revolving period ends, the amortization period begins. This is when the outstanding loans under the credit agreement need to be paid down to zero. The clock is ticking to get all that borrowed money back to the lenders. And finally, the legal final maturity date is set for the payment date in the 12th month following the revolving period termination date. This is the absolute final deadline for all payments to be settled. It gives them a whole extra year after the revolving period to wrap things up, providing a good buffer. So how does this all work day to day? The company's subsidiaries, called originators, will transfer consumer loan receivables to the company. Then the company sells these receivables to the borrower, which is their subsidiary that is managing this facility. These receivables are then pledged as collateral to secure the debt. Essentially, they are using the money owed to them by their customers to borrow more money from lenders. It is a common practice in the lending industry, but it comes with its own set of risks. Under the purchase agreement, the company's responsibility for repurchasing or fixing any receivables that don't meet certain criteria is limited. This means if a loan they sold to the borrower has an issue that existed before the sale, their obligation is capped. This is a win for the company as it limits their downside risk. Now, the credit agreement has some pretty strict rules called covenants. The servicer, which is WAC, has to maintain certain ratios related to how much money is overdue, how well customers are paying, and how much they expect to lose on bad loans. If they fail to keep these ratios in line, it can trigger those level 2 or level 3 trigger events we talked about earlier. This is how lenders protect themselves, they say. If your performance dips below this point, you're in trouble. And if things get really bad, if a servicing centralization event happens and the lenders demand it, they might have to centralize their servicing operations. This means setting up a lockbox where all payments go directly to the lenders or their representative. This is a strong signal that the lenders are taking more control. There are also servicer termination events which can lead to WAC, or its subsidiaries being removed as the servicer. This could happen if they fail to make payments, merge improperly, miss reporting deadlines, violate covenants, or face insolvency. If any of these happen, the lenders can bring in someone else to manage the loans. Of course, there are also standard events of default. These include things like not making payments, breaking covenants, the lenders losing their priority claim on the collateral, an insolvency event for the company or its subsidiaries, a change in control of the company, or a default on other major financing agreements. If these occur, the lenders can demand immediate repayment of all outstanding loans. This is the ultimate hammer to get their money back. It is worth noting that the filing mentions that certain exhibits are excluded and will be provided to the SEC upon request. This is standard practice for some documents, but it means we don't have the full picture in this public filing. Now let's look at the bigger picture for World Acceptance Corporation. This new warehouse facility is a critical piece of infrastructure, providing them with $175 million to work with. This is particularly important for a company in the consumer lending space where cash flow management and access to capital are paramount. The terms of the agreement, especially the trigger events and step, up margins, show a clear focus on risk mitigation for the lenders. The fact that the advance rate can be reduced to 70% if a level I trigger event occurs suggests that the lenders are closely monitoring the company's performance, particularly its ability to manage delinquent loans and charge. Offs, these are vital health indicators in any lending business. The complexity of the interest rate calculation, while in line with modern financial markets, highlights the dynamic nature of their borrowing costs. Being tied to benchmarks like SOFR means their expenses will fluctuate with broader economic conditions. The step up margin is a stark warning system. If WAC struggles to meet its obligations or if there is a significant negative event, the cost of this funding will escalate dramatically, potentially putting further strain on their finances. The covenants around delinquency and charge. Off ratios are the real test for WAC. Can they consistently manage their loan portfolio to keep these metrics within agreed upon bands? A failure here doesn't just mean a higher interest rate. It can lead to more severe consequences like loss of servicing rights or even demands for immediate repayment. This facility, while providing much needed capital, also imposes a rigorous discipline on the company's operations. Overall, this filing signals a key strategic move by World Acceptance Corporation to bolster its financial foundation. It demonstrates their ongoing access to credit markets, something vital for a company that issues loans. However, the stringent terms attached suggest that lenders are proceeding with caution and expect a high level of operational excellence from the company. The success of this facility will depend heavily on WAC's ability to maintain strong performance in its core business of consumer lending, navigating potential economic headwinds and regulatory shifts. Alright, that is our breakdown of World Acceptance Corporation. Latest filing. What is your take on these numbers and what they signal for the company's future? Do you think this new funding will be a game changer, or does the complexity of the terms raise any red flags for you? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into corporate filings. And don't forget to check out our Discord community linked in the description for more discussions and insights into the world of finance. Thanks for watching. See you next time.